All right, welcome everybody to another episode of Advance Your Wealth. I'm Homer Smith, founder of Convergent Wealth Partners and the director of the DK Family Office. And today we're going to be doing our normal monthly segment on kind of a look back at the markets and economy over the last month, as well as a look ahead to what we see coming. And joining me today, as he has been the last few months, is Joseph Sikora from Aptus. Yeah, Aptus is our back office chief investment officer group. So they provide a lot of research support for our team and developing our models. And they're actually just in general a great resource for market and economic information. So excited to have them as a part of our team and looking forward to the call today. So Joseph, welcome back.
Yeah, pleasure to do it. Hope I can keep coming back. It's a good time.
All right, great. Well, as I like to start usually is just kind of a quick look back at the month back, just in our words, and to help our clients kind of navigate all of the noise out there. What did you see as some kind of critical things that occurred in August, whether it's with the markets or the economy, and then kind of looking ahead to what's coming up in the coming weeks in September? What do you guys see coming?
Sure. Yeah. So August was a down month for equities and an up month for interest rates. Kind of saw a pretty big move to the downside for equities in the first part of August, and then kind of a rally into the end of the month to recoup most of those losses and end up with fairly small downside for equities in August. Kind of a quick recap on earnings season. At this point, we're closer to the end of 3Q earnings season than we are 2Q, but as reporting is delayed and takes a while to get in, we now have kind of a holistic look at what earnings look like for the second quarter. And for the most part, they came in better than expected. Now, year-over-year numbers were still negative for earnings. They were negative to the tune of about 3.5% year-over-year. But at the start of earnings season, if you go back to July 1st, analysts were expecting that number to be closer to negative 6%. Actually, it was negative 5.7%. So you can see earnings expectations had been dropped, and then end up beating those lower numbers. Sales expectations actually came in positive year-over-year when they were expecting to come in slightly negative. So I guess you can use the kind of industry term better than feared on what happened. And for the most part, equity markets applauded that. And you've actually seen expectations for 2023 earnings start to flatten out after really pretty much being negatively revised all year long. You've seen them start to flatten out now that we've got 2 quarters in the books, and start to tick higher. So you've seen that also for profit margins. Profit margins were coming down, and now they started to tick higher. And you've even seen for 2024 earnings, which of course is over a year away, before that's all said and done, start to level out as well. And 2024 earnings are expected to be about 11% higher than where 23 earnings are going to be. So you've seen a lot of, after coming into the beginning of the year with a lot of recessionary fears, you've seen a market that's been extremely resilient because the earnings picture and the macroeconomic data has been fairly resilient. So still some pause for concern, I guess, on the horizon, but for the most part, earnings were good, and the outlook has been pretty good so far this year.
So what you're saying is this bear market's behind us. It's nothing but all-time highs from here. Nothing to worry about, right?
Right. Yeah. I mean, what could go wrong? And part of that is why the markets did not go lower at the beginning of the year, because everyone had the exact opposite of that sentiment. Everyone thought a recession is imminent. We're going to go down. And when a market's positioned that way, it's really hard for it to actually happen. There almost has to be some element of surprise for things to go wrong. And now we've seen sentiment change a lot, to not to the extremes of what you just said, but the data has been pretty good. Earnings have been better, as I said. So the market's gone a lot higher. Valuations have gone a lot higher. We're sitting at north of 19 times P ratio for 2023 on equity markets.
I thought an interesting chart that we were going over earlier this week when we were speaking was, in spite of earnings, I guess, being better than expected, you showed us some information that we can put up on the screen that, while the market's been up, pretty much most, if not all of that return has been, you say, multiple expansion, or the price to earnings ratio going up versus, really rise in profitability of these companies. Anything to add to that, or thoughts around kind of, is that healthy? Is that normal in a I guess a not bull market necessarily, but a growing economy to see multiple expansion to that extent without really any earnings to back it up.
Right. Yeah. And you're exactly right. So if you go back to the market low in October 12th of last year, you had a forward P multiple of about 15 times, a little bit higher than that. And we got as high as 20 times, a little bit back in the end of July before markets traded down just a little bit. So all of the increase in market price this year has been from increased valuation. The earnings have actually been negatively revised over the course of the year. They've been lower, or for the full year, they've been expected to come in lower than they were when we were making those expectations at the end of 2022. So we would call that generally unhealthy. Earnings drive markets. Valuations are a reflection of sentiment and to some degree interest rates. What you're discounting future earnings at, what interest rate that is incorporated in how you value from an equity multiple perspective. So if equity multiples are going higher, especially in the face of rising interest rates, we've seen rising interest rates this year, then you would say there has been a market response that's been, from a sentiment perspective, been somewhat aggressive, where you've had a lot of people buoy up equity prices based on sentiment as opposed necessarily to fundamentals, at least in the hope that future fundamentals will be better. So when you come out of down markets, that typically is the case. But if there's not, in pretty short order, follow through in terms of the earnings response, then you find yourself in a market that from a risk return perspective might be a little bit off center. So you could argue that's where we are right now. But as long as the data keeps coming back increasingly encouraging, then it's going to buy time for this market.
So on that, so thinking of, good news being good news and bad news being bad news, which is, probably a healthy environment to be in. Oftentimes this last year, we've seen bad news be good news, so that, the worse the data comes in, the less likely the Fed continues to raise rates or hold them steady and maybe even starts to lower them. Do you still see that playing out as some of the macro data continues to come in, or how do you see that playing out right now?
Yeah. So equity prices have a very high positive correlation with earnings revisions, positive earnings revisions. So as earnings are revised upward because of increasingly good outlooks from analysts for individual companies, that has a positive impact on equity prices, and that makes sense. Now, what you would expect also is that as macroeconomic data improves, you'd expect that to be a positive read through for equity markets as well. But as you just said, as we've seen a lot of the last year, and a good case in point was just the last half of August here, sometimes good news in macroeconomic data is not good news for equity markets, because right now it tends to be a tell on what the markets think the Fed's going to do with future interest rate hikes or cuts. So right now, the market really wants the Fed to cut interest rates. They've been betting on that really ever since the Fed started raising rates in March of 2022, and they continue to be disappointed over and over again, have to push out these cuts further and further to the future. So when economic data, whether it be sentiment, whether it be inflation, whether it be job readings, comes back in line to below expectations, what that tells the market is that the Fed is getting their wish for slowing aggregate demand, and they're going to have the ability to cut interest rates, which will ultimately buoy equity markets. And then when data comes back stronger than expected, it has the opposite effect. It tells the market that the Fed's going to have stay put, keep interest rates high, and that's going to be kind of a damper, kind of a ceiling on equity prices. So in the back half of August, what we saw is that equity markets had gone down for most of the month. And then right about the middle of the month, economic data started coming back a little bit worse than expected. You saw interest rates pull back pretty materially, especially on the long end. And you saw equity markets kind of get that bump into the end of the month, into Labor Day weekend. So again, that's not something you typically want to see in a healthy market. You want to see what's good be translated into something good as far as asset prices go. But everything right now still pivots a lot around what the Fed's going to do, how that's going to inflect upon future interest rate expectations, which in turn will then help dictate what happens in equity markets.
We're not in the prediction game, and we always tell clients we're not trying to predict what's to come. We just want to be prepared for whatever might be coming. So I'm going to go on a limb here and ask you a little bit, though, is, if we were to see inflation data start to tick back up again. We've seen some higher oil prices and commodity prices in the last month, while at the same time seeing some, maybe worsening economic data continue, kind of putting the Fed in a pretty tough spot of maybe not being able to discuss lowering rates so quickly and having to state that they'll have to keep things potentially higher for longer. What's the risk that might be sitting out there that, with the markets that maybe currently isn't being priced in with something like that?
Yeah, I think the main risk, and we touched on this earlier, is just the fact that equity markets are priced for, I wouldn't say perfection, but they're priced pretty aggressively right now. And we use the P multiple as kind of a proxy for that. So at roughly 19, 20 times 2023 earnings, you're at a level that historically is pretty elevated for equity markets. Now, that doesn't mean that can't be sustainable or that's not justified. But if you have a situation like you're saying, where inflation it turns out to be more entrenched than people think, and the Fed has to stay at higher interest rates for longer, then you can argue a P multiple of 20 times is in fact pretty aggressive. If you were entering this period of uncertainty at a market multiple of, say, 16 to 18 times, which has a greater deal of historical precedent, over the last several decades, then you could say that risks are fairly balanced. But from here, and we follow a lot of research partners that have said the same thing. Maybe there's not a recession imminent. Maybe inflation is not going to, blow out again. But it's just your risk return profile right now, where the equity markets are valued, is you could argue maybe a little bit out of skew, and that gives us a little pause for concern. But like you said, doesn't mean we time markets. It means that we own what we need to own, and then we make sure we own protection in our portfolios in order to provide for things that, quite frankly, we can't forecast.
All right. Well, good. Well, I know we've been focused mostly up to this point on kind of shorter term, last month or two ahead. I know you guys also look at some longer term, bigger picture correlations and things related to the market. So what are you guys, seeing? We talk a lot, and with clients, we talked a lot about kind of the death of the 60/40 portfolio and how data has changed significantly since the early 80s, when that risk reward setup was pretty perfect for that type of a portfolio. What are you guys seeing in that area now, and how it impacts, portfolio construction, and how we should be thinking about that?
Yeah, it's kind of a neat question that's coming up now. The 60/40 portfolio has just kind of been the bedrock of asset management for the last several decades. It, however, is really predicated on an idea of negative correlation between stocks and bonds. So stocks are kind of the engine, the driver of the portfolio, and bonds sort of yin when stocks yang, and provide income in the meantime by way of coupon that bonds pay, interest payments. However, what we see is that negative correlation between stocks and bonds, while it holds up in the last 20 years, if you look back historically, it doesn't hold up. If you look at the late 60s kind of through the late 90s, so a period of over 30 years, you see that oftentimes stock and bond correlations are actually positive. And we've seen the reemergence of that correlation here in the last 2 years. And the seeming constant between those periods is higher interest rates. So when you have periods of higher inflation, a 10-year treasury yield that's above 10%, above 4% roughly, we see correlations between bonds and stocks trend higher. And then in the lower interest rate environment that we had over the last 2 decades, especially the last decade after great financial crisis and the ensuing QE that came about, we had bond stock correlations that were negative, and it was a really good environment for the 60/40 portfolio. So one thing we've been thinking through a lot is maybe not as a 60/40 dead, but can we can we do that a better way? Can we own less bonds and run portfolios in such a way that our equities drive returns, but we still manage that downside? And we think we can do that better by owning volatility, which is option-based strategies in a portfolio, a broader equity portfolio that can drive returns, but then also provide true negative correlation in the form of downside protection, so we can balance the risk return of the profiles that we run. So
yeah, which obviously why we're working together, because it's right in line with our philosophy of making sure the defense is always on the field when your offense is out there looking to score. So so good. Well, I think that's been kind of helpful in thinking about the bigger picture, and maybe as things play out here in the next few months with inflation and interest rates, we'll be able to speak more to that. So any last comments before we wrap up our August review and kind of September look ahead here today?
Glad football season's here, and I'm glad the weather's getting below 100 now.
Yeah, so you guys are out in Alabama. So Alabama or Auburn?
Alabama. It's not even a question.
All right. Well, hopefully we didn't lose any fans of you, Joseph, with that comment. But we'll look forward to talking to you guys soon, and roll Tide.
Yep.